Rambling, incoherent response, were you even close to anything that could be considered a rational thought?
Oh my gosh, I love that opening. Every time I do that opening of our show, I get to watch the camera of our guests going, "You talking about me?" It's like, "No, I'm not talking about you. It's just the other guy." We do have some great things in the show today. Welcome to the show. My name is Doug Crowe, author of your brand show, and you're going to want to take notes. Our guest today, oh my gosh, great background, decades of experience in financial advice for individuals and families since 1986, maybe before some of you were born. After starting his career with a large firm, he felt maybe the products were limited, the services were not always available. He made a decision, like a lot of entrepreneurs, to form his own registered investment advisory, RIA firm, Tandem Growth Financial Advisors. And that gave him the freedom to offer holistic, objective advice that he believes his clients need and deserve. And we're going to talk about this today because he's got a book about it. So welcome to the show today, my guest, Mr. Jeff Bernier.
Well,
how you doing?
Thank you, Doug. Doing great. I loved your opening too. In the work that I do, we talk a lot about how to make healthy investment decisions.
Yeah.
And so when he mentioned that you haven't had one rational thought, oftentimes we invest emotionally,
yes,
and not rationally. So that hit close to home.
Good. I'm glad you enjoyed it. So we're going to get into the meat here in a minute. And the meat's going to be really about a lot of our clients and friends and people watching the show are in midlife. And it's a whole new chapter of what do I do now? I might be retiring soon. Do I have enough money? Is my mindset right? We're going to get to that in a second and have some great ideas for our audience about the 6 major challenges that you've figured out how to help people overcome and navigate around. But before we do, I want to know about you, how you got involved in the financial planning industry.
Well, I was really fortunate. I grew up in a great home in a small town in South Georgia, and my dad was.
I thought you were from New York with that accent. Really?
No.
Georgia, huh? Amazing.
Yeah, I know it shocks people. And my dad was George Bailey, if you know who George Bailey is. So he was the character in A Wonderful Life. He was a hometown banker. So I was influenced by him. Went to the University of Georgia and got a degree in finance.
Yeah.
And met a gentleman who was a certified financial planner when I was in college, and just decided that's what I wanted to do. So I got really lucky and started in this industry. April Fool's Day, 1986.
Hopefully that's not a sign. Okay, well, I'm sure it's not. You've done well with yourself. So we're going to get to the major challenges here and how you help people overcome them. Before we do, why do people face these things? What is going on in our culture or society where this should be an easy transition, but it seems to be more stress for a lot of people? Why is that?
Well, I mean, as we build our lives, we're just busy, and we spend the first, fourth of our lives trying to get educated and trying to build capability. I've heard people talk about like a football game. So that first quarter, you're building your capability, and then the middle 2 quarters are generally earning and saving quarters where you build up some financial resources. But what happens again is many people, as they start having success, both worldly success and building portfolios and get titles and career success and beach houses and second home and big cars and big homes, and they educate their children. At some point, you psychologically get to a point where you begin to wonder, is this all there is? And it can be a really challenging time. So what I've tried to do in my work is try to combine deep discovery around what matters most, and then try to apply highly technical, excellent wealth management advice to help create the capacity to go pursue your vision of what matters most. But we're hit again with the challenging times because again, we don't have pension plans like our parents had or our grandparents had. We were concerned about government benefits like Social Security and Medicare and all those kind of things, even being around. So there's just a lot of challenges.
Yeah, a lot of unknowns out there. So you mentioned earlier there's 6 major challenges of midlife and people transitioning from where they are to no paycheck. Do you want to go through the 6 challenges and tell us what they are and how you navigate them?
Yeah. So we live in a really challenging time as we prepare for this, for these seasons. And
Yeah.
the first one I would say is that the future will not be identical to the past.
Right.
And if we take historical returns of the major investment classes
Yeah.
and extrapolate those going forward, we may be making a major mistake,
Mm.
because we may be, at least in a secular time period, where expected returns are lower. So that's one, lower returns in traditional financial assets.
Hmm.
So we have to be prepared for potentially a lower expected return world. The second one is similar to that. And even though interest rates have gone up over the last year, as
Yeah.
your listeners probably well know, if they've tried to refinance their mortgage or buy a house,
Yeah.
yields on bonds are still historically low.
Mm.
So we've got low returns in equity-linked investments, including real estate.
Yep.
We've got lower returns or yields in bonds.
Hmm.
The third one is a blessing and a curse all at the same time, and that is we're just living longer.
Yeah.
So
Right. Right.
we're retiring earlier and living longer. So my typical 60-year-old couple that's retiring at age 60,
Yeah.
they've got to plan on 30 to 35 years of potential life expectancy.
Sure.
So
Right.
another challenge is just longevity,
Right.
life expectancy.
Yeah.
I alluded to another one when I talked about government programs. I mean,
Uh-huh.
is for your younger or mid-career listener, there's some questions on what a Social Security might look like 20 years from now and 30 years from now.
That's right.
So the confidence in government programs. And then
Yeah.
the last one that and healthcare costs. I mean, I guess that's not the last one. Healthcare costs are obviously a big issue as we
Right.
age. And then the last one, it kind of alludes to what I mentioned before about your intro with rational versus emotional.
Yes. Mhm.
And that is, we've lived through a couple of really severe bear markets here since the tech bubble burst. I mean, we had the
Sure.
tech bubble, we had the Great Recession, of course, we had the
Mhm.
pandemic, and
Mhm.
so many people are making behavioral mistakes
Ah.
with their investments that they may never recover from. So the last one is just a unprepared investor may be making behavioral mistakes that they may not be able to recover from. So those are some of the challenges that we have to deal with as we
Wow.
build a plan.
Well, let's cover the easy ones first, if there is an easy one. But you mentioned something really wise, that the past does not predict the future, right? Things could, obviously, the pandemic showed us that you can't depend on past performance is no assurance of future.
That's right.
And I keep think about the inflation, the printing all this money up. Like, where is this going? Are we going to have buckets of wheelbarrows of cash like Venezuela and Germany in the 20s? I mean, how do you hedge? What do you do to hedge for that kind of stuff? That kind of severe thinking?
Well, I think it's important to have a general idea how we got here, is kind of some of the points you just made. I mean, economic growth really since roughly 2000 has been slow historically. So for the first 150 years or so, economic growth was much faster than it's been since 2000. So since 2000, central banks have been trying to prime the pump all over the world. And, then we had the Great Recession. And so the Federal Reserve and central banks all over the world instituted non-conventional monetary policy to try to keep the patient who was in the emergency room in the intensive care unit from dying. And because of that, they again instituted a lot of non-traditional monetary policy. And since that time, it's continued. And then, of course, so for the last 10 or 15 years, we've had artificially low interest rates.
Yes.
And that's been really good for those of us that own financial assets. And real estate. I mean, it means our portfolios or our real estate is much more valuable than it likely would have been had we had more less accommodative monetary policy.
Right.
But the problem today is now we've got these asset prices that are high, and now you've got lower expected returns because we front loaded a lot of the growth, if you will.
Yeah. Right.
And now the Federal Reserve is trying to normalize and take the punch bowl away, because it's created this massive inflation problem.
Mhm.
But the simple answer to your question is clients are going to have to make some difficult choices. So there's no free lunch. So in order to get higher returns, you've got to accept more uncertainty. I mean, there's no way, that you can't get high returns with less uncertainty. So
Sure.
my typical client is likely to have to either appreciate or get comfortable with strategies that have more volatility to get the same rate of return, or the thing that nobody really wants to do is manage their wants. So
Yeah.
manage what you need.
Yeah, that's why I like what you said about being holistic. It's not just about the money; it's about your attitude and beliefs and things that go with that, right? That's important.
And it's all interrelated.
Yeah.
When you're talking about the behavioral challenges and you're talking about
Mhm.
the inflation challenge, it is all interrelated. Like, occasionally people will say, look, I want to buy guaranteed income products, and those are fine. If you want to guarantee income over a
Mhm.
long period of time, that may be suitable for some people.
Sure.
But those same individuals are reluctant to delay Social Security.
Yeah.
And if you're trying to have the best hedge out there is to wait and take Social Security at 70 instead of
Yeah.
62,
Sure.
as an example.
Mhm.
But the long answer is you've got to own asset classes that have historically given you a real return over inflation, and that is equity-based investments, either real estate, businesses, or public securities.
Right. So that's a great one. So yeah, because every time I look at mutual funds and stocks, I'm like, I don't know. I mean, it looks okay, but I know there's just a lot of manipulation going on. I'm like, I don't know what's going. No one really know kind of. But equity makes more sense to me when it comes to businesses and real estate, and whatnot. How can a typical investor, middle income America, invest in any of the non-traditional assets like that, equity-based stuff?
Yeah, well, this is where I might be different than some of my peers.
Yeah.
Is I believe that most investors shouldn't be in quote non-traditional asset classes,
Okay.
um, because most of them are too expensive,
Uh-huh.
and it relies on active management.
Right.
And so we employ what I would call evidence-based investing. So we're
Hmm.
using strategies that are peer-reviewed, academic, researched, and the academic literature indicates that active management over time hasn't added enough value to cover their cost.
Oh, really?
Now, again, if you want to take the risk to be a shareholder in a business, a small business, I mean,
Yeah.
I think that's great, as long
Mhm.
as you understand the risk, because most
Yep.
small businesses fail.
Right.
But I believe that our clients will likely meet their goals
Mhm.
if they can capture uh, the returns that the markets provide. But there are factors that can give you higher expected returns. So you can get higher expected returns by tilting to things like smaller
Mhm.
companies as opposed to large companies,
Yep.
more value as opposed to growth
Mhm.
stocks,
Mhm.
and then more profitable companies relative to less profitable companies.
Right. Yeah.
So there are things you can do in public equities that can increase your expected returns, but it's not a free lunch
Yeah.
because
Right.
there is more risk.
There's more risk with the smaller companies
Correct.
in the
Yeah. So there
stock.
are several, correct. So if you look at the market, if you look at the public markets, there are various premiums that you receive for
Mhm.
accepting different types of risk.
Right.
So you get the market premium just by owning stocks instead of cash or bonds.
Got
So
it.
that's the market premium, and that's a reliable premium. But you're taking more volatility.
Mm.
There's also a small cap premium, which is to say, over time, smaller companies have historically given you higher returns than larger companies.
Mhm.
And it makes sense because they're riskier. You're getting
Yeah.
compensated for taking more risk. So that's the small cap premium. There's
Mhm.
also a value premium.
Right.
Those stocks in other asset classes, it's just not limited to stocks,
Yeah.
that have low prices relative to fundamentals have historically also given you higher returns. But
Yeah.
again, it's not a free lunch.
Right.
You're getting the higher return because these value companies have low prices for a reason. They're
That's
not
right. Yeah.
they're either not popular or they've got some challenges.
Yeah.
So that's the value premium. There's also a profitability premium. Now, this one sounds counterintuitive. It sounds counterintuitive why you should be rewarded for it. Let me rephrase that.
Okay.
It makes perfect sense that if you own companies that are more profitable, you should do better than owning companies that are less profitable.
Yeah.
Well, you and I both infer that. That seems like common sense to us.
Sure.
Well, if the market knows it, it ought to already be in the price.
Yeah.
And you shouldn't be rewarded for it. But in reality, you are rewarded for it. So you get high returns for owning more profitable companies. And then there are other factors, but the last one that we think is important is there is short-term momentum. So you can also profit by owning things that have gone up recently. And that's really a behavioral reason, most likely. Investors are slow to react.
Yeah. What would be an example of that?
Well, when you look at stocks that have done well recently, so over the last 12 months, the academic evidence indicates that those stocks continue to do well, even though they've gotten expensive because of some positive momentum.
Got it. Okay.
And securities that have done poorly recently continue to do poorly over a period of time. So it's really kind of a trend following. And what's important to know about that is that is almost all behavioral because investors are slow to react to news. So they'll continue to own large growth tech stocks as an example, because we had a tech run from 2015 through 2020 or 21.
Right.
And that's changed recently, but investors are slow to react. And so the only point I'm making is there are ways that you can improve upon a market cap weighted index that you can improve expected returns. So that's really the general idea on some of those factors.
I like that. So when it comes to the opportunities, let's talk about somebody's like, hey, I want to start investing. I know, big disclaimer here, okay? Jeff is not giving you investment advice on this show. Doug is asking some very general questions, so I understand the compliance issues here.
Right.
But in terms of like new technologies, like the AI, machine learning, robotics thing, electric cars, I keep thinking like, well, there's like, the gold rush and the people sold them picks and shovels. And the guys that sold picks and shovels usually did make as much, but it was much more secure. Are there opportunities in this emerging technological stuff that's going on right now in that arena where they're just somebody who's building the AI stuff or robots?
Yeah, I'm certain that there are. But the problem is most of us won't know about them till much later.
Yeah.
And most of it that's public that we know about is already in the price.
Yeah.
So once the market knows about these advancing technologies, it's already in the price, and it's going to be difficult to get excess returns from it. And so I think what I would caution investors on is the first thing you've got to do is determine what your philosophy is.
Yep.
Wall Street is a dangerous place to try to figure out your philosophy. So what I would encourage people to do is read about various investment philosophies and find one that makes sense to you. And because the most important thing is find a philosophy that makes sense to you that you can stick with.
Yeah.
And that's the problem. And our philosophy is that markets are largely efficient. And so our opinion is you should invest as if markets are efficient, because we believe our clients will meet their goals if we can at least capture what markets deliver in a low cost, tax efficient way. And trying to speculate on the hot new thing, I think, is dangerous for many people.
That makes a lot of sense, because the smart people that are pulling those strings, and you're not going to get ahead of them. I don't think that makes a lot of sense. Thank you for that. Yeah. I know you got a book out. Before we close the show, let's talk about your book for a second. You got a copy handy or not?
Yeah, I sure do.
Yeah, hold it up there.
It's called The Money and Meaning Journey. A guide. I may be reversed here, but it's called The Money and Meaning Journey. A guide to clarity, financial confidence, and joy. And it's really all about how to go. How to make the second act of your life the best act.
Nice.
There's really three parts to the book. The first part kind of digs into these challenges that my hero, this mid to late career executive, is facing. The middle part of the book is a workshop 3 chapters. It kind of works you through trying to figure out your purpose, your context, and how to build capacity. And the last half of the book is a wealth management toolbox, if you will.
Oh, nice. Great. Very good. Any quotes or words of wisdom before we close the show out today to tell people how to not lose their butt in the market?
Yeah. Well, I mean, I guess what I would say is I'll just leave you with, human nature is a failed investor.
Yeah.
And so don't to react to markets. So build a financial plan based on your goals and objectives, and certainly think long-term. I think that would be helpful.
Yeah.
And if you'd like to learn more about me and the book, you can find the book at all the major retailers, Amazon and so forth, and also at jeffbernierauthor.com. And you can find me and our firm at tandemgrowth.com if you have interest in learning more.
And all those links are below here, folks. So look at the show notes below. All the links are there. Get Jeff's book. And if you need some financial advice, he's your guy. Jeff, thanks so much for being on the show today. Appreciate it.
Enjoy being with you. Thank you, Doug.
That concludes another episode of the Author Your Brand Show with another slightly famous author with some great information. Check out the show notes below. And if you're inclined, please get his book. Thank you very much. Until next time, this is your host, Doug Crowe.